So Okta just dropped their latest earnings, and on the surface, the quarter looked absolutely fantastic. They beat expectations on pretty much every important metric. So why in the world did the stock immediately drop after hours? Well, that's a big puzzle we're going to unpack right here.
Here's how we're going to break it all down. First, we'll look at the numbers that, on paper, made the quarter look so strong. Then we'll dive into management's really ambitious new AI strategy. From there, we'll try to figure out the market's surprisingly cold reaction, weigh the bull and bear arguments, and finally, I'll give you our official Talk Tickers rating and tell you what we're watching for next.
All right, let's jump right into Section 1. If you're just looking at the hard numbers, it is really tough to find anything wrong with what Okta just delivered. The results were just solid. Okay, right out of the gate, a big beat on the bottom line. We're looking at non-GAAP earnings per share, which is basically a measure of profit. It came in at 82 cents. Now, Wall Street was only looking for about 75 cents, so that's a 7-cent beat, a really nice upside surprise.
And it wasn't just on earnings. Nope. Revenue also came in comfortably ahead of what people were expecting, hitting $742 million. That's more than $11 million above the consensus and marks a pretty healthy 12% growth from last year.
And, this strength was pretty much everywhere you looked. It wasn't some one-off thing. Their operating margin expanded by an incredible 3 percentage points to 24%. And even better, their free cash flow margin, which is a great sign of financial health, hit 28%, way up from 23% a year ago. Seriously, by any standard measure, this was a very, very strong report. So with numbers that good, you'd think that's all anyone on the earnings call would be talking about, right? Well, not exactly. In Section 2, we'll see how management really wanted to shift the conversation from the present to the future, with a big pivot to AI.
On the call, the CEO, Todd McKinnon, basically boiled their entire new strategy down to this one really powerful idea. AI security is identity security. And let me tell you, this wasn't just a catchy soundbite, it's the foundation for their entire vision moving forward.
So here's the game plan. They're launching new products specifically designed to secure AI systems. The goal is to become this essential neutral identity layer for all the AI agents running around inside a company. And the business model? This is the really clever part. They plan to charge for these AI agents just like they charge for human users, which could blow their potential market wide open. And it's not just a dream. They're already talking to over 100 customers about it. The vision is to secure a future filled with these autonomous AI identities.
Which brings us right to the heart of the mystery here. Section 3, the market's muted reaction. I mean, if the numbers were great and the story for the future is so exciting, why on earth did the stock fall?
This is the exact question that had investors just scratching their heads. It was a classic beat and raise. They beat past results and raised future guidance. That's supposed to be the best case scenario. So what gives?
The answer came pretty fast in after-hours trading. You can see the stock closed the day just under $82. But as soon as those numbers hit the wire, it dropped to around $79. That's a 3.5% haircut. Now, it's not a total collapse, but it is definitely not the celebration you'd expect.
And here it is. Here's the culprit, the forward-looking guidance. See, investors are always looking ahead. The real problem was in a metric called CRPO. Just think of it as the company's backlog, all the business they've signed but haven't recognized as revenue yet. That backlog grew 13% in Q3, which is good, but the guidance for Q4 pointed to that growth slowing down a lot, to just 9%. In a market that is obsessed with growth acceleration, a slowdown like that is a huge red flag.
So this really sets up the current debate perfectly. We're in Section 4, from growth to profits. Investors are now trying to figure out what Okta is. Is it still a high-growth company, or is it becoming more of a slower, more profitable value story?
So let's look at the two sides of the coin. The bulls, they're buying into that big AI vision. They see a massive new market, and they point to the company's amazing profitability and strong balance sheet. But the bears, they're focused on the here and now. They see the slowing growth, they see that the AI revenue is still just a story, not a reality, and they point out that the stock has been lagging behind its peers. Plus, a flat net retention rate of 106% suggests existing customers aren't really spending much more than they used to.
So, with all that on the table, where do we stand? In our final section, I'm going to give you the official Talk Tickers verdict on Okta.
We're going to break this down into 3 simple parts. First, I'll tell you what we think will happen with Q4 results. Second, what we expect from the stock price. And third, we'll assign our official rating.
Okay, for Q4, we fully expect Okta to beat its own guidance. They tend to be conservative, so look for revenue to come in at the high end, maybe even a little above their stated range. Same thing for earnings, but honestly, the Q4 numbers aren't the main event. The real catalyst, the number everyone is going to be glued to, is the guidance for the next full year. The market needs to see a clear sign that growth is picking back up.
Given that dynamic, our forecast for the stock is that it's going to be pretty much stuck in a range for a while. You've got a really solid floor under the stock, supported by all that cash flow and profit, but you've also got a ceiling, capped by those worries about slowing growth. Until that exciting AI story starts turning into actual, accelerating revenue, it's just hard to see the stock making a big move.
Which brings us to our final rating, market perform. Look, Okta is a well-run, very profitable company, but right now it's in the show-me stage with investors. It has to prove it can get that top-line growth engine humming again to earn a higher valuation. Until then, we expect it to perform pretty much in line with the rest of the market.
And as always, just a quick reminder, this is not financial advice.
So, we'll leave you with this one big question to think about. Is Okta's AI pivot a true game changer that's going to unlock a massive new wave of growth? Or is it just a new story for a good company that's naturally maturing and settling into a slower pace? The answer to that question is going to define this stock for years to come.